Now, step 4 in this processing cycle is to transfer the debit or credit information from the journal to the general ledger accounts. So this slide contains the ledger account in a T-count account form for address right after all of the general journal transactions have been posted. So the reference GJ1 next to each of the posted amounts indicates that the source of the entries from page 1 of the general journal. The ledger accounts also contain a posting reference, usually the page number of the journal in which the journal entry was recorded. The reason we do this is to allow for cross-referencing between the journal and the ledger. Now this slide shows the summary of all the balance sheet accounts posted in the general ledger. Let me move this down so you can see it well. Okie-doke, moving on. This slide shows the summary of all of the income statement accounts that are posted in the general ledger. Next, we are going to prepare an adjusted trial balance for step 5. Now this is required before we prepare any financial statements and before we do any adjusting entries. We call those internal transactions, that these get recorded at the end of the period. So this trial balance is just really pretty simple. It's a list of all the general ledger accounts listed in the order they appear in the ledger, along with their balances at a particular date. The purpose is to allow us to check for completeness and to prove that the sum of the accounts with debit balances equal the sum of the accounts with credit balances. Remember, we always want that balance, the accounting equation, to be in balance. So the fact that the debits and credits are equal doesn't necessarily mean that we have everything perfect. It just means that the debits equal the credits. The trial balance could contain offsetting errors, and we'll talk about that later, how we can learn how the trial balance can facilitate preparing adjusting entries. So as you're going to see right here, this slide shows you the unadjusted trial balance. You can see the date, July 31st, 2018 for the Dress Right Clothing Corp. See that the retained earnings has a debit balance of $1,000. Now this reflects the payment of the cash dividend to the shareholders. The increase and decrease in retained earnings from revenue, expense, gain, and loss transactions are recorded indirectly into temporary accounts. But before the start of the next year, these increases and decreases get transferred over to the retained earnings account. Note also that the sum of all the debit balances is equal to the sum of all the credit balances. So you see the sales revenue, the cost of goods sold, and salaries expense. Those are the temporary accounts that we will zero out and transfer over into retained earnings. This next step is in this cycle is to record in the general journal and post to the ledger accounts the effect of any internal events on the accounting equation. Now, these transactions don't involve an exchange transaction with another entity, so we don't have a source document in order to do these. They are recorded at the end of a period when financial statements get prepared. We normally call these entries adjusting entries. These adjusting entries are required to implement the accrual accounting model. These entries help to ensure that all revenues earned and expenses incurred are recognized during the respective periods, regardless of when the cash is received or when the cash is paid. So as you see here, the adjusting entries are necessary in 3 specific situations. When we're dealing with prepayments, which we sometimes call deferrals, when we're dealing with accruals and estimates. Now, prepayments are transactions in which the cash flow precedes expense or revenue recognition. Prepayments include prepaid expenses and deferred revenues. Then there's another one, accruals. These involve transactions where the cash outflow or inflow takes place in a period subsequent to expense or revenue recognition. So accruals include accrued liabilities and accrued receivables. Accountants often must make estimates of future events in order to comply with the accrual accounting model. And we'll talk about this in this next slide. So let's talk about prepayments. Those occur when the cash flow precedes either expense or revenue recognition. Let's say a company buys supplies in one period but uses them in a later period. Another one, prepaid expenses. The cost of assets acquired in one period and expensed in a future period. So payment made by a company for insurance for future periods is an asset to the company that we call prepaid insurance. Now the asset gets expensed in the future period when the asset expires. Now in insurance, it's going to expire just over the passage of time. We normally pay for insurance in, say, 12 months. So each month that it expires, it gets reduced from the prepaid and it gets increased to the insurance expense. So the adjusting entry for a prepaid expense is a debit to an expense and a credit to an asset. We're increasing the expense and we decrease the asset. Ultimately, it helps to reduce our net income, but it will also reduce the asset balance in the balance sheet. So let's look at some instances of how information from an adjusted trial balance may be used to record adjusting entries. So from the unadjusted trial balance of the Dress Right Clothing Corporation, we find that the supplies of $2,000 were purchased during the month of July. Now this transaction created an asset as the supplies are going to be used in future periods. So the company could either track the supplies used or simply count the supplies at the end of the period and to determine the dollar amount of supplies remaining. So assume that Dress Right determines that at the end of July, $1,200 of supplies remain of the $2,000 that were purchased. Well, with the help of T accounts, we can determine that the company used up $800 of supplies during the period. So the adjusting journal entry to record this is a debit to the supplies expense account, so it increases the expense, and it's a credit to the supplies account, the asset, for $800. The credit, again, remember, it reduces the asset account. After this entry is recorded and posted to the ledger accounts, the supplies account is reduced to a new balance of a $1,200 debit. And the supplies expense account will have an $800 debit balance. Next, at the beginning of July, the company paid $24,000 to its landlord, representing 1 year's rent paid in advance. As it's reasonable to assume that the rent services provided for each period are equal, the monthly rent is $2,000. So at the end of July 2018, 1 month of prepaid rent has expired, and now it needs to be recognized as an expense. So the adjusting journal entry for this is a debit to rent expense and a credit to prepaid rent for $2,000. This records the cost of the expired rent for the month of July. After this entry gets recorded and posted to the ledger accounts, now the prepaid rent account will have a debit balance of $22,000, which only represents 11 remaining months at $2,000 per month, and now the rent expense will have a $2,000 debit balance. The final prepayment involves the asset represented by office equipment that was purchased for $12,000. This asset has a long life, but is going to expire over time. Remember, an asset is a resource that will provide a future benefit. So the amount of monthly expense that we call depreciation expense is $200, which is $12,000 divided by 60 months. This required adjusting entries a debit to depreciation expense for $200, and it's also a credit to this contra account called accumulated depreciation office equipment. Now the entry reduces an asset, office equipment, by $200. However, the asset account isn't reduced directly. Instead, the credit is to an account called accumulated depreciation that we know as a contra account to office equipment. Now, the normal balance in a contra account will always be a credit. That is contra or opposite to the normal debit balance in an asset account. So the purpose of this account is to keep the original cost of the asset intact while reducing it indirectly. In the balance sheet, office equipment is reported net of accumulated depreciation. After this entry is recorded and posted to the ledger accounts, the accumulated depreciation account will have a credit balance of $200, and the depreciation account will have a $200 debit balance. Note that if a required adjusting entry for a prepaid expense doesn't get recorded, then net income, assets, and shareholders' equity will all be overstated. Think about it. Net income gets overstated because we didn't record an expense that we should. The asset gets overstated because we don't have that accumulated depreciation that reduces the asset minus that accumulated depreciation gives us our net asset. And ultimately, our shareholders' equity account is overstated because ultimately the net income flows back into the shareholders' equity, and our net income was recorded too high because we forgot to take an expense here. So now, let's look at a question. The correct amount of prepaid insurance shown on a company's December 31st, 2018 balance sheet was $1,400. On May 1st of 2019, the company paid an additional insurance premium of $1,100. In the December 31st, 2019 balance sheet, the amount of prepaid insurance was correctly shown as $1,000. The amount of insurance expense that should appear in the company's 2019 income statement is it $2,000, $1,900, $1,500, or $1,600? So we've got a beginning balance of $1,400. We paid an additional $1,100. That makes it $2,500. At the end of the period, if we're showing only $1,000 left, that means $1,500 of this was taken out. It was debited to insurance expense, and we credited our prepaid insurance. Now let's look at something called deferred revenues. Deferred revenues are created when a company receives cash from a customer in one period for goods or services to be provided in a future period. So the cash receipt that comes in from an external person is recorded as a debit to cash since it's increasing our cash, but it gets recorded as a credit to a liability, deferred revenue. This is one of the few liability accounts that doesn't have the word payable after it. This liability shows the company has an obligation to provide goods or services in the future. Again, liabilities are future sacrifices. That is what this deferred revenue account consists of. Now, once again, the unadjusted trial balance provides information concerning deferred revenues. So for Dress Right Clothing Corporation, the only deferred revenue in the trial balance is deferred rent revenue. Remember, the company subleased a portion of the building to a jewelry store for $500 a month. On July 16th, the jewelry store paid Dress Right $1,000 in advance for the first 2 months of rent. So the external transaction was recorded at that time as a debit to cash and a credit to deferred rent revenue. At the end of July, 1/2 of 1 month's rent service has been provided, or $250. So the required adjusting journal entry reduces deferred rent revenue with a debit and increases the revenue account rent revenue with a credit for $250. After this entry is recorded and posted to the ledger accounts, the deferred rent revenue account is reduced to a credit balance of $750 for the remaining 1.5 months' rent. And the rent revenue account will have a $250 credit balance. If we don't record this entry, then net income and also shareholders' equity through retained earnings would be understated, and the liabilities would at that time be overstated. So let's look at this concept question. The Contra Costa Times Company reported a $17,200 liability in its 2018 balance sheet for subscription revenue received in advance. During 2019, $68,000 was received from customers for subscriptions, and the 2019 income statement reported subscription revenue of $69,700. What is the liability amount for deferred subscription revenue that will appear in the 2019 balance sheet? I'm going to give you a minute to think on this. Well, let's look at this. We start the period with $17,200 as the beginning balance. We add $68,000 of receipts for customer prescriptions. And the subscription revenue that has been recognized is $69,700, which means we reduced it from the liability and showed it as revenue. So the remaining balance in this liability account, known as deferred revenue, is $15,500. Okay, now let's look at some other ways that we can that can be applied to achieve the same end result for prepayments by recording the external transaction directly to an expense or revenue account. So the adjusting entry then records the unexpired prepaid expense, which is an asset, or a deferred revenue, which is a liability, as of the end of the period. Here's an example. On July 1st, 2018, DressRight paid $24,000 in cash for 1 year's rent on its building. Now, this could be recorded as a debit to rent expense and a credit to cash. The adjusting entry then records the amount of prepaid rent as of the end of July, $22,000, and reduces rent expense to $2,000, the cost of rent for the month of July. Well, the net effect of handling the transaction in this way is the same as the previous treatment. But either way, the prepaid rent account will have a debit balance at the end of July of $22,000, and rent expense will have a debit balance of $2,000. So, what's important here is that an adjusting entry is recorded to make sure the appropriate amounts are reflected in both the expense and asset before we prepare the financial statements. Now, here is a way we could do deferred revenues differently. So, in this scenario, the example of deferred rent revenue that we talked about earlier, so the July 16th cash balance from the jewelry store representing an advance of 2 months' rent could have been recorded by DressRight as a credit to rent revenue instead of deferred rent revenue, which is a liability. Now, if DressRight records the entire $1,000 as rent revenue this way, it would then prepare an adjusting entry to record the amount of deferred revenue as of the end of July, $750 to represent the 1.5 month of rent revenue remaining and collected in advance, and then the rent revenue account would have a credit balance of $250. So the amount of revenue recognized during the 1/2 month of July that has passed in the current period. Now, let's look at accruals. So accruals involve transactions where the cash outflow or inflow takes place in a period after or subsequent to the expense or revenue recognition. So we're going to see the cash happening after we record the revenue or the expense. So for example, a company often uses the services of another entity in one period and yet pays for them in the next period. An expense is recognized in the period it was incurred, and an accrued liability is recorded. Also, goods and services often are provided to customers on credit. So in this situation, a revenue is recognized in the period goods or services are transferred to customers, and an asset, which is called a receivable, gets recorded. Many accruals involve external transactions that automatically are recorded from a source document. A sales invoice for a credit sale provides all the information necessary to record the debit to accounts receivable and the credit to sales revenue. There are some accruals that involve internal transactions and then require adjusting entries. But because accruals involve recognition of expense or revenue before cash flows, the unadjusted trial balance won't be as helpful in identifying required adjusting entries as they are with prepayments. Accrued liabilities represents liabilities recorded when an expense has been incurred prior to being paid. the adjusting entry recorded for an accrued liability is a debit to an expense and a credit to a liability. Now, on July 20th, the company paid employees $5,000 for salaries for the first half of the month. So salaries for the second half of July aren't going to be paid till August. Nevertheless, the company incurred an expense in July for services provided to it by its employees. There exists an obligation at the end of July to pay the salaries earned by the employees. So an adjusting entry is required to increase salaries expense, which decreases shareholders' equity, and then to increase the liability for the salaries payable. Now, the adjusting entry for an accrued liability always includes a debit to the expense and a credit to the liability. So, as you see here, after this entry gets recorded and posted to the general ledger, the salaries expense account will have a debit balance of $10,500, which is the $5,000 initially plus the $5,500, and the salaries payable account will have a credit balance of $5,500, that which we still need to pay. Whenever the trial balance reveals interest-bearing debt, the interest is not paid on the last day of the period. If it's not, then we need to make an adjusting entry for the amount of interest that has built up since the last payment date, or the last date interest was accrued. So interest rates usually are stated as an annual rate. The trial balance has a balance in the notes payable account of $40,000. The company borrowed this amount on July 1st of 18, shown by two notes, each requiring the payment of 10% interest. Now, in this case, we calculate interest as an annual rate multiplied by the principal amount multiplied by the amount of time left. In this case, 1 month or 1/12 of a year. So the adjusting entry debits the interest expense and it credits interest payable. This entry records the interest expense accrued for July on notes payable. After this entry is recorded and posted to the ledger accounts, the interest expense account will have a debit balance of $333, and the interest payable account will have a credit balance of $333. Remember to not record this adjusting entry for an accrued liability would cause our net income and our shareholders' equity through retained earnings to be overstated, and our liabilities would then be understated. Let's look at another question. Gary's Grocery borrowed $12,000 at 8% interest on May 1st, 2018, with principal and interest due on April 31st, 2019. Now, the company's fiscal year ends December 31st. What amount of interest expense would appear in the company's income statement for the year ended December 31st, 2018 related to this loan? I'll give you a minute to think about this. So as you can see here, we're going to take the $12,000 loan times 8%, which is at an annual rate, times 8 months out of 12 months, or $640 would be shown as the interest expense. Now, accrued receivables involve the recognition of revenue for goods and services transferred to customers before cash is received. The adjusting entry required to record an accrued revenue is a debit to an asset, which would be a receivable, and then a credit to the revenue account. So let's assume that Dress-Right loaned another corporation $30,000 at the beginning of August, evidenced by a note receivable. Terms of the note call for the payment of principal $30,000 and interest at 8% in 3 months. An external transaction records the cash disbursement, a debit to notes receivable and a credit to cash of $30,000. Dress-Right must record the interest revenue earned but not yet received along with the corresponding receivable. Interest receivable increases and interest revenue, which ultimately flows into shareholders' equity through retained earnings, also increases. At the end of August, Dress-Right recognizes $200 in interest revenue. 30,000 times 8% times 1/12. The adjusting entry is a debit to interest receivable and a credit to interest revenue for $200. If this entry doesn't get recorded, we've got net income, assets, and shareholders' equity through retained earnings would all be understated. So, a third classification of adjusting entries are estimates. Accountants often must make estimates of future events to comply with the accrual accounting model. For example, the calculation of depreciation expense requires an estimate of the expected useful life of an asset being depreciated, and also the residual value is just an estimate. One adjusting entry situation involving an estimate that does not fit neatly into either the prepayment or accrual classification is bad debts. Accounting for bad debts requires a company to estimate the amount of accounts receivable that ultimately is going to be uncollectible. And as a result of that, we reduce the accounts receivable by that estimated amount. This isn't a prepayment, and it's not an accrual because it doesn't involve the payment of cash either before or after income is reduced. After the adjusting entries are all posted to the general ledger account, then the next step is to prepare an adjusted trial balance. The term adjusted refers to the fact that these adjusting entries have now been posted to the accounts. Here you'll see the adjusted trial balance. Remember, in a trial balance, at any time the total of debit balances should equal the total of all credit balances. Now, the unadjusted trial balance we talked about earlier, note that after the adjusting entries, the total differs between the unadjusted trial balance and the adjusted trial balance. Also, the total of debt balances still equals the total of all credit balances. Then, finally, the purpose of all these steps is to get to this point, the preparation of financial statements. The adjusted trial balance contains the necessary information. The financial statements are the primary means of communicating financial information to the external parties. The income statement is a change statement that summarizes the profit-generating transactions that cause shareholders' equity through retained earnings to change during the period. The purpose of the Statement of Comprehensive Income is to report the changes in shareholders' equity during the period that were not the result of transactions with owners. The balance sheet is a position statement that presents an organized list of assets, liabilities, and equity at a particular snapshot in time. Balance sheet items usually are classified into groups according to common characteristics: assets that are resources, liabilities that are claims that we need to pay that are owed, and then stockholders' equity that are claims of the owners. Finally, the statement of cash flows is used to summarize the transactions that caused cash to change during the period. So the final statement, the statement of shareholders' equity, discloses the sources of the changes in the various permanent shareholders' equity accounts that happened during the period, from investments by owners, distributions to owners, net income, and other comprehensive income. We're going to stop here and move on with the next lecture.